Friday afternoon, you're at the kitchen table. Bills on one side, coffee on the other, a lifetime of work in the middle. Then your phone lights up. Silver, down, again. Not a little pullback, not healthy profit taking. A trapdoor. And gold? Gold dumps again, like somebody kicked the supports out. They're going to tell you it's normal. They're going to say, markets breathe. They're going to say, nothing to see here. That's the lullaby for the sleeping herd. But you're not here for lullabies, because what you just watched was a controlled burn, a lever pulled behind the curtain, a rule change that turns grown men into forced sellers. And if you're over 55, that matters more than anything. You don't get to ride it out for 10 years. You don't get to make up losses with another decade of overtime. Your timeline is shorter. Your patience is real. Your savings are sacred. So listen, this meltdown is not about silver being risky. This is about the system showing its teeth. Imagine this. You wake up next week, you open your retirement account, the balance is there, the number looks fine, then you go shopping. The card is lighter, the receipt is heavier, the medicine costs more. The insurance letter comes with another increase. The property taxes creep up again, and you realize something that hits like cold water. The number didn't change, but your life did. That's inflation, the silent pickpocket. Now add this. In the same week, you hear market volatility. You see silver crash, you see gold crash, you see anchors on TV smiling like everything is fine. And deep down you know, something is broken. Here's what they won't say out loud. Silver didn't crash because silver failed. Silver crashed because leverage got squeezed, and the people holding the leverage got crushed. That's the real monster in the room. Margin, a word that sounds boring until it steals your choices. Here's the simple picture. A paper metals market is a casino. Futures are the betting slips, and margin is the cover charge. When the casino wants fewer players, it raises the cover charge. Overnight, you either pay or you're tossed out. And the bouncer doesn't ask nicely. He takes your chips. He sells your hand. He locks in your loss. That's what forced liquidation means. Now, what happened in silver was violent for a reason. Silver ran like a rocket. It surged roughly 170% in 2025. Then it surged again early 2026, about another 60%. It even hit a peak around $121 an ounce. Then it plunged hard. One Friday, it dropped as much as 36% intraday. 36 in one day. That's not a normal market. That's a stampede. And stampedes aren't accidents. They're triggered by fear, by headlines, by leverage, by rules. Now here's the switch that matters. CME raised margin requirements effective Monday, February 2nd, 2026. Gold margin reported moving from about 6% to 8%. Silver margin from about 11% to 15%. Those look like small numbers. They're not small, because those percentages sit on top of a giant pile of exposure. On COMEX, one silver futures contract represents 5,000 ounces. 5,000. If silver is around $70 an ounce, one contract controls about $385,000 worth of silver. But the trader doesn't pay $385,000. He posts margin, a fraction, a deposit. At 11% margin, that's about $42,350. At 15% margin, it's about $57,750. That's an extra $15,400 per contract, due immediately. Now picture the smart money who levered up. 10 contracts, not rare in a frenzy. That's $154,000 more cash required. Right now, no delay, no mercy. Where does that cash come from? It doesn't. So the market does what markets do when leverage gets strangled. It sells. Not because it wants to, because it has to. And when the selling starts, it feeds itself. Price drops, margin calls rise, more selling. Price drops again, more calls, more selling. A blender, a meat grinder, a chute that gets narrower as the crowd pushes harder. This isn't a theory, this is math. Now you might ask, fine, silver got hit, but why is gold getting slammed too? Because in a margin panic, people don't sell what they want. They sell what they can. Gold is liquid. Gold is used as collateral. Gold becomes the piggy bank. So they smash gold to raise cash to meet margin calls in other positions. That's why gold dumps again. Not because gold lost its purpose, because leverage lost control. And if paper gold can get dumped like that, what do you think happens to paper everything? Stocks, bonds, real estate funds, retirement portfolios stuffed with promises. Here's the part nobody wants to face. The system isn't built to protect you. It's built to protect itself. And when it's threatened, it changes rules mid-game. You just watched it happen with margin. One quiet decision. Millions forced to sell. Headlines call it risk management. But it's really a weapon. Because the people who get hurt first are always the same. Latecomers, the retirees, the folks who did what they were told, the sleeping herd. They hear, Just stay invested. They hear time in the market. They hear diversify. Meanwhile, the insiders are already moving, already hedging, already calling their brokers, already raising cash, already pulling lifeboats off the rack. And they don't announce it. They don't warn you. They just leave you the bill. Now let's talk about the bill. The bill is not just a red number on a screen. The bill is higher prices. The bill is lost purchasing power. The bill is stress you feel in your stomach. The bill is choosing between comfort and security. And the older you are, the sharper that knife feels. Because you can't work your way out of a currency problem. You can only prepare or get squeezed. Now the system offers you comfort words, FDIC, SIPC. They say those letters like a magic shield, but read the fine print. FDIC deposit insurance is generally up to $250,000 per depositor, per insured bank, per ownership category. If you've got $400,000 in one bank in one category, you're exposed. And even if you're under that limit, FDIC doesn't protect your purchasing power. It doesn't stop inflation. It doesn't stop delays. It doesn't stop new restrictions. It covers bank failure within rules. That's it. Then brokerage accounts. SIPC protection is limited too, up to $500,000 total, including a $250,000 limit for cash. Again, that doesn't stop markets from dropping 20% or 30%. It doesn't stop a system outage. It doesn't stop a temporary restriction. It covers missing assets and a very specific kind of failure. Now here's the uncomfortable question. What happens when the failure is not one bank? What happens when the failure is confidence? Because confidence is what holds paper together. And confidence is fragile. You can feel it in the air when people start saying something doesn't feel right. That's when the trap gets sprung. Because the first thing governments do in stress is the same thing exchanges do. They change conditions. They call it stability. They call it security. They call it for your protection. But protection for who? For the system, for the institutions, for the people closest to the money printer. Not for you. Imagine this. You go to the ATM, black screen, not broken, just unavailable. You try another. Same. You call the bank. You get a recording. Due to higher than normal call volume, you finally get an agent. They read a script. System-wide issue. Try again later. Later becomes tomorrow. Tomorrow becomes next week. Meanwhile, you still need groceries. You still need medicine. Life doesn't pause for system-wide issues. Now imagine another version. You're trying to transfer money to help your granddaughter. A bill, a school payment, a sudden emergency. You hit send, and the app says, pending. You call. They say it's for security. They can't tell you how long. They can't promise a time. Your money is there, but your access isn't. That is the trap. Modern money isn't money. It's permission. And permission can be delayed, denied, reviewed, flagged. Now you might say, that sounds extreme. No, what's extreme is watching a 36% crash in silver and pretending it's normal. What's extreme is watching a margin hike trigger forced liquidation and calling it risk management. Whew. What's extreme is trusting a system that changes rules mid-game and thinking it won't do it again, because it will. And the next chapter is already being written. Digital control, CBDCs, digital dollars, programmable money. Now, the Federal Reserve has said FedNow is not a CBDC and not replacing cash. They've also said a CBDC would require an authorizing law. Do you hear what that means? It means it's not a fantasy. It's a policy decision. It means the door isn't welded shut. It's waiting on paperwork. And lawmakers are fighting about it. There's a bill called H.R. 1919, the Anti-CBDC Surveillance State Act, aimed at blocking a CBDC and limiting certain Fed actions. And the Fed chair has said the Fed won't introduce a CBDC during his tenure, at least through May 2026. Notice the wording. During my tenure. Not never. Not impossible. Just not yet. And that's how the system talks when it wants you calm, because calm people don't prepare. Calm people comply. Now don't get distracted. The real point isn't whether a CBDC arrives tomorrow. The point is the direction. More digital rails, more tracking, more switches, more levers. And when you live inside a system made of switches, you can be shut off with a switch. Silver just gave you the lesson in miniature. A crowded trade, a rule change, a forced exit. Now apply that to the rest of your life. Your bank, your brokerage, your spending. That's why you feel that knot, because you can sense the Titanic. It's shiny, it's loud, it's confident. They tell you it's unsinkable, then you hit the iceberg, and at first, nothing looks wrong. That's when the sleeping herd stays in the cabin. They trust the announcements, they wait for instructions, and by the time they rush to the deck, the lifeboats are already gone. Now we talk lifeboats. Not speculation, not a get-rich scheme, not a chart. Physical metal, gold and silver in your possession, not as a toy, as a tool, as survival, as freedom. Because physical metal is a bearer asset. Bearer asset means if you hold it, you own it. No password, no approval, no pending review. No margin call. It doesn't care about a broker's server. It doesn't care about an app outage. It doesn't care about a new rule at the exchange. It's there, quiet, honest, unimpressed by headlines. Now, here's the part the system hates. Physical metal removes counterparty risk. Counterparty risk is just this. How many people have to keep their promise for you to be safe? With a bank account, you need the bank, the payment network, regulators, power, internet, and the app. With a brokerage, you need the broker, the custodian, the clearinghouse, the exchange, and liquidity. With paper metals, you need all of that, plus the exchange not changing margin, plus your broker not liquidating you at the bottom. That's a long chain. Chain snap. Physical metal shortens the chain, you, and the metal. That's why central banks still hold gold. Even the people who create paper still cling to metal. That tells you everything. Now, some people will say, but silver just crashed. Why would I want that? Because you're confusing paper price action with physical purpose. Silver crashing in the casino is exactly why you want an exit from the casino. You don't buy a lifeboat because the ocean is calm. You buy it because the ocean can turn. And it turns fast. Silver showed you speed, a rally that looked unstoppable, then a drop that looked impossible. That's what leveraged markets do. They don't glide, they snap. And retirees can't afford snap events. Now let's make it real again. Imagine this. It's 6 months from now. You hear the phrase temporary restrictions. You hear stability measures. You hear for your protection. And you realize the rules changed again. Maybe it's withdrawal limits. Maybe it's transfer delays. Maybe it's new reporting. Maybe it's a new verification step. Maybe it's a new excuse. The details don't matter because the pattern is the same. When the system is stressed, it controls exits. That's why you prepare before the stress hits, not after. After is too late. After is when the sleeping herd panics. After is when shelves get empty. After is when premiums jump. After is when the phone lines are jammed. After is when you discover that liquidity is a word that disappears when you need it. And don't let them distract you with scapegoats. They'll blame speculators. They'll blame China. They'll blame social media. Or they'll blame anybody except the system that allowed a crowded, leveraged trade to pile up like dry tinder. Here's the question nobody asks on television. Why is the game built so that a few rule changes can wipe out the crowd in hours? Because that's how control stays centralized. They let the crowd run up the stairs, then they pull the rug, then they buy back cheaper, then they call it a cleansing. That is not a free market. That is a managed arena. And you know who suffers most in a managed arena? People who can't afford to be forced out at the worst moment. Retirees. Imagine this. It's winter. Your heating bill arrives. Higher again. I guess you think, fine, I'll move money. You log in, you attempt a transfer, and you get a message you've never seen before. Additional verification required. You upload documents. You wait. You call. You get bounced around. Days pass. The bill doesn't wait. Or imagine this. You're at the gas station. Card reader says declined. You try again. Declined. You have money. You can prove it. But the system doesn't care what you can prove. It cares what it will allow. That's why the core issue isn't a price chart. It's dependence. If your wealth only exists as digits inside their system, then they control your wealth. They can delay it. They can ration it. They can change terms with a smile and call it temporary. Temporary is the most permanent word in government. So what do you do before the next switch? You build a lifeboat, a layer you can hold, a layer outside the banking chain, a layer that doesn't need an app, a layer that doesn't need permission. You don't need a fortune to start. You need the mindset shift from trust to possession, from they'll take care of me to I will not be trapped. That's the difference between the sleeping herd and the awakened few. One waits, one prepares. Now, here's the honest truth. Most people will ignore this. They will go back to sleep. They will wait for permission. They will wait for a headline that is big enough, but the headline is already here. Silver meltdown, margin hike, forced liquidation, gold dump. That is the headline. It's the rehearsal. And rehearsals exist for one reason. So you don't freeze when the real thing starts. So here's your move. Become your own central bank. Not in some fancy way, in a simple way. Hold a portion of your savings outside the system, where it can't be frozen by an app, where it can't be margin called by an exchange, where it can't be diluted by a printer. Physical gold, physical silver in your possession. That's not investing. That's opting out of the trap. That's putting a lifeboat within reach. Because the next switch won't come with a warning. And when it flips, the sleeping herd will stare at a screen and ask, "What happened?" The awakened few will already know, and they'll already be prepared. If you want to survive what's coming, subscribe to Currency Rewind. Not for entertainment, for truth, for readiness, for the kind of calm that only preparation gives. And leave this thought sitting in your mind tonight. They can raise margins with one notice. They can force selling with one switch. So ask yourself the only question that matters. When the next switch flips, will your wealth still be trapped inside their system, or will some of it be in your hands?